happen in the way that they view it. But the ones that, when I talk about master plan communities, it's not necessarily the Konzas and the Tatus. There'll be smaller developments, which I believe are more realistic currently. So I think the very huge ambitious ones, Isiolo Resort City, and all these ones, they require such huge government intervention. And if it doesn't happen, it can seriously bankrupt any developer to try to get in there. However, what I think we will see is smaller ones, smaller scale ones, and those will become more and more as we go along. And then hopefully over time, as capacity develops, then they will grow and get bigger. Much as the country is growing, there are limits to how far we can go. I'll give you just one last one. The capacity of our professional and construction firms is actually a limitation in this market. That is why you have seen the Chinese coming. It is not simply because they are coming in because they have money from China. It is to respond to opportunity. Now, there is severe limitations here when you look at our professional and contracting companies. So, realizing the concepts of this world, I feel those are still highly ambitious, highly aspirational projects. But you'll see others that will come up which are much more sustainable, and they are driven by socio-economic trends. That is very critical. Development should not happen in just a vacuum. It has to be driven by socio-economic trends. So you will see socio-economic trends being the ones driving the new master development.
Yeah, I mean, speaking of Garden City, I think we have to make a distinction between the models. I think, Tatu City and the Resort City, those are master plan developments. You have a master developer whose primary role is to put in infrastructure, possibly develop one component. I think I agree that the smaller, more manageable ones, Garden City, I think, being one of those, where it's only 32 acres. Actis is not assuming a master developer role. We are developing all the components, and we've ensured we're capitalized to do that. And it's within a time frame that is realistic, because frankly, we have a 10-year fund cycle. We have to invest and deploy and repatriate profits back in 10 years. So that forces you to be very disciplined. It forces you to be very realistic in terms of the scale that you can assume. So I think you'll see a number of those. And I think the Centum Two Rivers is another good example of smaller, more manageable projects that can be delivered within a very realistic time frame. Hope that the Konza City type developments kick off, but as Edward says, it requires massive government support.
Yeah, I think I want to agree with my other colleagues that these big developments will take time and the concept will sink in. However, from the perspective that it's an issue of branding, how do we then brand them and how do we deliver them? It's true the government has to come in heavily, and does the government have the capacity then to do that? Is it within its priority to do that? And like he said, if it doesn't, then leave the developers with huge debt.
All right, thank you. That was very informative. And we can please give them a round of applause. And because we're focused people, we're going to have these guys get off the stage and another set of people come on the stage to speak about I'll call the next set of people up. They're still being mic'd up, but what we're going to be speaking about is investment overview. And you had the word rates thrown around, which is obviously something you're familiar with, which is real estate investment trusts. Looking at that as well as other ways to invest in real estate. The third gentleman who's getting his microphone put on, so we'll address a whole lot of them when they're here. But the whole point of how do you actually look at an investment into real estate, if you're looking at it from an overall perspective, is a question we'd like to answer in the next session. So about 15 seconds and he will come up. fancy technology. So because you were last, we'll begin with you. Introducing the people who are up here. Kevin Chirvengadam, who's CEO of African Land Investments. We also have Dimitri Kokinos, portfolio manager for Stanley Direct Property Third Party Fund. I hope I got that correct. How do you fit that in a business card? And Luke Kinoti, CEO of Visions Capital Group, and in any order, Luke, starting with you. In terms of looking at investing in the real estate sector in this part of the world, where is the money available? How do you, from what Kwame was saying, exit within a certain period of time? Is it purely bring in money, put up houses, and hope to sell them on?
Thank you. Where's the money coming from? And I'm sure that's a question majority of us ask, particularly in Nairobi and other cities right now in East Africa. Keep on asking, where is the money coming from? But from our own experience, right now, we have quite a lot of inquiries, and particularly there's a lot of money coming from outside the East Africa countries themselves. The development, particularly of big either estates or even commercial. There is a lot of money coming from outside. But also we have seen and experienced the locals themselves, particularly in Kenya, coming very strongly to contribute to the building of either new estates or commercial buildings that are taking place. The issue of exit and putting up the buildings, we have seen a very strong interest on, particularly from the local community, the East African investors themselves, in wanting to retain what they develop. However, from the investors from outside, they want to exit. Particularly our own experience tells us that in 5 years, they want to exit. They say, we want to develop, and after development, just want to exit. And that's where the local investors also come in to buy or in a developed facility.
Dimitri, there was huge numbers thrown up at the very beginning. $55 billion, billions of shillings and dollars and other currencies thrown around, implying there's pools of money in certain places on the continent. There's lots of need in other parts of the continent. How does that money flow work? Is it you sit, for example, in a place like South Africa and decide Rwanda needs real estate investment, and so let's put in $1 billion in Rwanda, or is it more complicated than that?
I don't think you can just say, take money from here, put it over there.
It's not that easy.
I think you need to look at pools of cash. So you need to look at where's that money coming from and what is the purpose thereof. So, you'll have a private equity fund, you'll have a mandate who can invest cross-border, and then you'll have pension funds who are not really allowed to invest cross-border, and they have to invest in their country specific. So I don't think it's fair to say, here's a pool of cash, just move it and shift it around. I think you need to look at what is the mandate of that cash and how can it get used.
Is it easy to change mandates? Let me give you an example. The social security sector in lots of the world, including East Africa, it tends to be the biggest amount of money. But your money, say in Kenya, the NSSF, the National Social Security Fund in Kenya, and there's demand in a place like Uganda, even demand in a place like South Africa. Do you ever go and lobby and say, listen guys, I know why you're doing what you're doing, which is trying to keep that money in country, but there's lots of returns to be had elsewhere. So moving the money, like you said, cross borders.
I think you can. I think there's more to real estate investment than just let's buy property. It is how do we retain the wealth for our country? How do we retain the wealth for our shareholders or our policy holders? So I think there's retirement benefits, those regulations around that govern that. But definitely you can go and lobby. And we're starting to see allocations that allow us to go outside borders, but not as aggressive as you'd want it to be.
Kevin, your company is very interesting, named African Land Investments. I mean, there's nothing more brutal than saying it's exactly like that. How easy is it to invest in land in Africa?
Well, interestingly, we're not even investors.
Sorry, 1 second, they'll adjust it. Try it again.
Running for the last 6 months.
Sorry, just start again. Your mic was off.
Okay. We're basically a very new company. We've been up and running for the last 6 months, and we're in the business of buying completed assets. So with our focus being basically buying completed malls. So we've bought our first shopping center, which is the Manda Hill Shopping Center in Lusaka, which is currently the biggest mall outside South Africa, in sub-Saharan Africa, which is around 44,000 squares. And we're looking at buying other malls in East Africa and also West Africa. So we're in the business of buying completed properties and providing yields to our investors. We've got two solid shareholders from South Africa. Our biggest shareholder is Hyprop, which is one of the biggest listed South African property fund, and also Attack, which is also a newly listed South African property company with a combined market cap of around $4 billion. So our intention is to grow over the next couple of years, is hopefully to grow to $500 million of assets under management. So we going around and looking for opportunities to buy completed properties. So we'll provide an exit to the likes of my previous colleagues, Kume of Actis, currently building Garden City, for example, or other developers who are building malls. So we'll come in and provide an exit to the developers.
So you guys do the easy stuff.
I wish it was, yeah. No, it's not. I think it's sort of interesting. I'm going to go back to your original question. Where's the money coming from? I think what's sort of interesting, obviously having the ability to travel across the continent. I think East Africa is a very unique position in a way, because you guys are extremely blessed with the fact that there's money locally. It's a pretty deep market, even though you don't believe it, compared to other markets on the continent. And then B, you've got very good local developers in town. So when you drive around Nairobi, you drive around Westlands and Upper Hill, etc., most of the stuff that's currently being built, or that have been built over the last 2 decades, have been done by local money and by local developers, which is very different to other markets such as West Africa or even Southern Africa.
But here's my bit of facile thing, saying things is easy, because the impression I get, and please correct me, is people like Kome and all the rest will deal with things such as acquiring the land and all its complications thereof. You'll deal with things such as figuring out land title, figuring out things like permits and all the rest. Now, you come and purchase the completed property, take it off their hands, and obviously making money for investors. So if I was an investor sitting there and saying, I've got $1 million, can I come to you and put it into your fund to help me benefit from that?
Well, specifically our fund currently, we've got 2 shareholders, so it's not even a fund. I think it's the word fund is very fashionable today. It's like everybody's raising a fund. We're rather a company.
I've got a fund for petrol for my car, so you can invest in that.
There you go.
Be my guest.
So we've got 2 shareholders in our company, and they've sort of provided us with the firepower to go and buy. But then you've got other funds which are currently being set up, or you've got the likes of Sanlam Real Estate Fund that's been set up a year ago, that raised money from third-party investors, predominantly South Africa and international money, who are looking for African US dollar yields. That's sort of a different set of investors compared to us.
If you do look at that sort of environment, where what he is saying is that Kenya has actually had it pretty good, in the sense that the money is local. People want to invest in property locally in the country. What's your experience with that and, say, international money, in the sense of how patient is this money? Is it more patient if you're a Kenyan, you're prepared to deal with the nightmare of trying to navigate local authorities? What's the comparison between local and international money?
What is, when we talk about local money, a lot of money is in pension funds, of course, which we have got quite a number who have invested in real estate. We have got insurance companies. And we see also, like in Kenya, investment clubs, which have done quite tremendous good work in investment, and quite a number of families also. Now, how easy is that to go and do the investment, and looking at the local, call it the land issues? Of course, the land issues, depending on where they are and how it is done, there's quite a lot of very interesting cases that take place. But I might say, like in Kenya, it's quite easy, particularly if you know to go about it. I can't say seriously that somebody who is local or somebody who is from outside will have any difference in how to assess the land in Kenya. I think the law is quite straightforward. Either you are local or international, you are able to assess the land and to be able to partner either with a local person or even independent to do that development. We can say that, for example, if you want, like Uganda is where we have found a little more challenging sometimes, particularly if it's land that is outside the urban centers, that becomes a bit of a challenge. But I found within East Africa also, because we have invested across the whole of East Africa as a Kenyan-based company working within East Africa, we have found it quite easy to assess the land. And I don't think we are any different from any other international.
But what about the mindset? If I sit here, born and bred in Nairobi, and I think there's a property worth investing in the Westlands area, which is where we are right now, I might have a bit more patience with the local authority or a bit more patience with the banks than someone who comes in from outside and says, listen, I have to put in this money in the next 6 months or I'm going to go away and look for property in Lusaka.
The mind of I think the system is all the same. The local person is used to the local environment, how we do things, either slowly or get on a queue. But the international community definitely is a bit more impatient with our systems. And from where I sit right now, I'm happy if there's a little more facilitation to fast track the systems. That I agree with you. We are a bit slow, and the international community can become impatient.
Yeah. Did you experience in the different countries in the region or even wider into the continent?
So to date, I think you need to look at who your investor base is and why there's an affinity to property. So I think what you find in Kenya is people they have an affinity to it, they're aspirational, they want to own that property. If you look at Uganda, for example, it's more about returns. So I think it really depends on sort of why. So in Kenya, people are prepared to pay a lot more money to own the property, whereas in Uganda, if it doesn't make fundamental sense. So I haven't had that much experience outside of those two yet in the eastern sort of area.
In terms of government and how it responds to people wanting to come in and invest?
I think the government's done actually a brilliant thing in terms of bringing the REIT legislation in. There's a couple of flaws within the REIT legislation. It's something that's being worked on at the moment. But I think in terms of facilitating future investment and allowing people to go to the stock exchange, create an investment vehicle outside of families investing, outside of pension funds and retirement sort of funds, I think the government has definitely facilitated that.
If you look at the issue of, you said you've invested in Lusaka, for instance, in a shopping mall, and there's others coming up. The whole shift in Africa from what one might call much smaller, less organized ways, for example, to shop, and now moving into shopping malls. How is that process going on across the continent? Is it standard, is it regular that everyone now wants to put up shopping malls?
Well, I think there's clearly sort of a mismatch between demand and supply. You know, when you travel, whether you're going to Lagos or you're going to Douala or maybe a lesser extent Nairobi, because Nairobi, if you compare with other countries at least, it's more advanced, in terms of the number of A grade or B grade malls that you've got in town or currently under development, and then also the sophistication of your local tenants. You know, and again, you guys are in a region where you're blessed by the fact that you've got the depth of local tenants, which in other countries you don't. So typically what happens is you either rely on South African tenants expanding up north, or these days European tenants coming down south, basically. But I think, going back to your sort of original question, it's if you look at, you take a country like Zambia, which is a very small country, Lusaka is a city of 2.5 million people, and yet in a city of 2.5 million people, you've got around 80,000 square meters of GLA of A grade. Those are A grade malls that could be anywhere in Joburg, But you're seeing over the last 3-4 years, we've seen private equity money and also South African developers and developers from the Northern Hemisphere coming down and putting money in doing those developments. So if you fast forward to 5 years from now, you're going to have pretty much in each city, whether it's Nairobi or Kampala or Accra, Lagos, etc., you're going to have a number of new malls. But still, I still think those cities are going to be underserved because Nairobi, the population is growing. I mean, you've got guys from the rural areas moving to urban regions, and then your population growth as well is in the sort of 3%, 4% per annum. So you're still going to need more malls going forward.
If you think about it, and here I'm being purely speculative, sorry,
Can I
can you jump
comment
in?
on
Yeah,
that?
please.
I think what is happening is changing urban lifestyles. And to me, that is driving even the establishment of malls, particularly with the growing middle class and how they like to do their shopping. I think that is quite a major drive to what is happening, and shopping malls are becoming quite something to go by.
If I may ask, and you're free to jump in here, and so are you. If you look at the shopping mall phenomenon within Africa, is it possible the same way you have anchor tenants, typically a supermarket or whatever it is, within a shopping mall, is it possible for the mall to serve as an anchor development towards something residential, for instance? So you have a very nice shopping mall, and then around it develop very nicely organized urban setups.
I think, yes, I think you can, I think, probably you should have asked the question on the previous panel. Probably Graham would have been able to give you the response.
Graham is still sitting there. Graham, is that possible?
But yeah, I think as part of bigger master plan, absolutely, it does happen as cities grows as well. I mean, we've seen, for example, the likes of Actis, who've taken the opportunity of the fact that you've got a new motorway going along Thika Road and doing Garden City. 5 years ago, I think it was so questionable whether you would be able to do a 45,000 square meter mall in that part of town. So I think as you've got those big malls coming up, it gives the ability, the opportunities for people to say, you know what, I'd rather build my house in that sort of suburb, and that's what's going to happen in Nairobi. I mean, I'm always again, amazed by the ongoing traffic in downtown Nairobi. It took us around half an hour yesterday to drive 200 meters from the Intercom.
Welcome to the world.
And I don't know if the benchmark is trying to be like Lagos, but you're nearly there. But as you've got new malls being built on the outskirts, it makes more sense for people to live in the outskirts and also to work in the outskirts. So it's all the concept of live, work, and play.
Dimitri, let me be very friendly and put you on the spot. Where are the bubbles? Go on.
So I'm going to use a fundamental sort of approach.
Try it now.
I'm going to use a fundamental approach really in sort of answering that question. So for me, really property represents something that should track a bond, and then equity should be a lot more risky, and therefore the return should be better. So you would expect bonds, then property, then equities. If you look at what's happening actually in this market, it's slightly different in that it's first properties, bonds, and then equities. So for me, there's a bit of a mismatch in price in terms of where, I can't tell you where the bubble is, but I can tell you that at the moment, property seems quite pricey. Obviously, depending on where the bond rates go to, that will have an effect.
You're scaring a lot of people in the room when you say it looks quite pricey. The question, though, is there's a lot of pent-up demand, for example, in the shopping mall environment. With the previous panel, there's lots of pent-up demand for living space, for office space, and things like those. But look, when you sit down and say, where shall we invest? Because all this is looking very exciting, right? And it's possible. There are bubbles and there's overpricing in some certain segments. How do you decide where to go? Whether it's about putting up 20 townhouses or 100 apartments or an office park or whatever it is. How do you make those kind of decisions in terms of money?
One is that we are investing in both sectors, both real estate, housing, and commercial. In 2012, we carried out very in-depth research in-house across the whole of East Africa, and we were able to establish from our own perspective there's a gap in all the sectors. So that is one of the key things that we have information apart from what our big brothers, World Bank and IFC, can provide. Now, two things that come to very quickly to us is we first of all look for land, or together with partner with a landowner. Then within that area we do the necessary research. For example, is it a housing? And we establish the relevant demand for that kind of estate. Or is it a commercial grade A? we establish demand. So it's basically research-based because we realize that different areas will demand a certain kind of an office block or kind of an estate. For example, if you are building Mombasa, Nairobi, maybe around Kiambu Road, might be different than what you have kind of a house you put around Mombasa Road. Or if you're in Mombasa or in Nakuru. So different places. So we do that through research. Second, also we have got quite a number of investors who might be interested either in building. For example, like our president in Kigali, quite a number say, I'm interested in investment in this area, and I want my money to go to this kind of investment. So investors have got special interest on where they want their money to be invested, and also back that with a real research on specific area where we want to invest.
Dimitri, I keep asking all the hard questions. Political risk. And now you choose how to answer that question. You can look at it regionally, you can look at it from a much wider perspective. When you sit there and see certain headlines, for instance, or get a feel for certain trends going on in countries or regions, does that give you pause in terms of investment and say, listen, we hear East Africa is a very good place to be, but we have seen what's happened in South Sudan, or we hear what's happening in Kenya or in Uganda?
I was hoping you weren't going to ask me that question.
So should I not ask that question? I can take it away.
I think political risk exists in any jurisdiction that you actually look at. I think currently, if you look at what's happening here, it's a little bit more accentuated. I think there are, political risk for me is two things. It's sort of what does the government do, and then there's obviously I'm going to call it the terrorist sort of making a statement. So political risk, obviously, it needs to cover sort of what the land ownership is, can the government change the rules, or what happens with currency investment, etc. I think so far the precedent's been quite good on that. But then if you look at sort of what's happening on the other side, there is risk. And it was evident 2 nights ago again. So I think from an investor, you need to take that into account. I think there are ways of covering yourself, so there is a way of getting cover. MIGA likes sort of stuff like that. I think there's risk and it needs to be priced in.
Karen, actually, yours is the more particular. Sorry. Post Westgate, which is literally, you can almost see it from here, everyone everywhere in the world suddenly realized that malls make for very juicy targets. Now, you're buying very juicy malls. Do you ever sit down and think, this is not quite right? So if Zambia was to have a terrorist situation, your mall would be the perfect target.
I think you should come with us and buy malls. They're not that juicy, by the way. It's hard work, yeah. Number one, yeah. I think, it's sort of, when you look at terrorism, yeah, the reality, it can happen anywhere around the world, and it does happen anywhere around the world. It happened in London 6-7 years ago. It happened in Boston last year, and life just goes on, So I think you need to look at sort of the bigger picture, So for me, you need to look at Africa on a medium to long term, Look at the history. Where have we come from over the last 20 years? You've got free and fair elections in most countries on the continent. You've got government being booted out and opposition becoming government. You've got election on the back of 49.5%. Or 51.5%, where the opposition becomes the government in Accra, in Ghana, for example, and things happened and then you've got in other places, we've seen it, where, I'll give you another example, very simple example. In Zambia, 2.5 years ago, when you had the new regime, everybody was alarmed about, the president's Zambia's going to go the Zimbabwe route, whatever that means, But the reality is, when they come to power, they sort of realize that they have to work with the private sector, and they have to enable the framework to work with the private sector. And that's what we've seen in Zambia. Maybe 2 years ago, I remember the API in Johannesburg, the government came up with the SI-33, which prevented developers or investors to quote and receive money in dollars. And it took them 2 years to realize, which they did a couple of weeks ago, to realize that it hasn't been very much investor friendly, and they've gone back, allowing people to quote and receive payment in dollars. And on the back of that, you're going to see more investment coming in. So I think you need to look sort of bigger picture, where the continent was, where it is today, and where it's going forward. I mean, my personal experience, having been trawling on the continent since '98, I think it's the place to be. If you want to get decent returns, it's the place to be. But you need to work with the local private sector, and you also need to work with the local authorities. And I think my ex-colleague Kume indicated, Garden City is a classic example. It's very easy to bash down government, but I think we also need to celebrate when they actually provide good services.
Yeah, but Dimitri sort of separated them very well, which is the political risk we've just spoken about. All governments to me are like ships. When they turn everything, but it's very easy to see them turning. So you can predict there's going to be an election in 2 years, and so let's be careful then. But the point about terrorism, I still want to insist on it, because it could lead, for instance, and I'm half answering the question, where you say instead of doing a 40,000 squares mall, let's do something much smaller that doesn't create that big a target. Because now it's obvious that these things are looked at by people who may not have good intentions for them.
Well, I think that you probably need to invite one of the terrorists, and probably they're going to tell you.
Any terrorists in the room want to sit on my panel?
I can't respond for the guys. I mean, it's like, for me, flying down to Nairobi for this week, would I have thought, what happened 2 nights ago was going to happen.
But did it come into your considerations after Westgate, where you said shopping malls, they start rethinking certain
No, it does. I'm not going to deny it doesn't, but I think it's what you're going to see is what I'm hoping is developers going to think more about access. They're going to think more about the security aspects as well at the malls. But there's limitation in terms of what you can do. I mean, what I'm saying is, in the first world, in the US, almost every second year, you do have local terrorism where people just go in and just shoot whoever.
every 2 months.
So, there you go. So it happens. We deal with it and we move on. Yeah.
All right, there was.
So I agree absolutely with what you're saying. I think fundamentally you have to look at, is there demand for that center? And if there is demand for that center, you must make sure that it's as security conscious as possible. You can't build a smaller center just so you're more security conscious.
All right, again, me being fair, is there anyone wants to jump into the conversation? I don't see too many people. All right, final thoughts from where? Sorry. Oh, here you are. Sorry, I don't see you.
Yeah, just a quick question on these investments that you're making. Zambia is kind of an extension of South Africa, as you mentioned. It's quite urbanized, lots of developments, etc. You have other countries. Such as Tanzania and DRC, which probably have very little in infrastructure, and then others like Kigali or Nakuru, which are very small. So where do you place your bets? Do you go where it's organized, like Zambia, or where it's scale or limited competition, or virgin? How do you make the investment decision?
I assume that question is for Kevin?
I think it's for all of them, because I think Luke is in Rwanda, for example.
Each of you. Luke, Professor Davide.
Yeah, for us, we want to make our presence in all the countries of East Africa. So we don't discriminate in any country in East Africa right now. We are quite open, and we are driven by opportunity, and particularly in real estate, we have got a partner who is out there, we have no problem in a country of East Africa.
So Stanlib has identified all of those as territories they want to be in. It is a growing business, so we're concentrating here first, building a hub. So definitely there is room for that, for us to grow. But you need to get your team sound, and you need to understand where you're going to, and I think that's where we're at the moment. So we're ready to go.
Well, like I said, we're buying completed malls basically. So these are typically in countries where you've got decent infrastructure. So you've mentioned the likes of Zambia, Kenya, besides the roads, but that's still improving. We're going to be looking at Nigeria as well, and Ghana. So those are the countries where you've got, I would say, decent-ish infrastructure. I think it would be sort of premature for us to go and buy a mall in Kinshasa. In DRC, I don't think there is a mall right now in DRC. So.
All right, I was there a few weeks ago, but that's a very promising market, I must tell you.
And if yes, is management contract, which is the predominant way of looking at hotel development from an international brand point of view, is that something which you are looking at?
We're in the business of buying malls, so we at this point in time, I don't think it's from a shareholders' perspective as well. We're not going to be buying hotels. But having said that, for example, we've bought Mandy Hill. There might be an opportunity of putting a hotel as part of the structure. So we're going to look at it as long as it's a small percentage to the lettable space overall in terms of the development. Going back to your second question, I think we've seen, and that's sort of with my previous outfit prior to African Land, we've seen a lot of international hotel operators coming into this market, including Kempinski, which, by the way, is a fantastic hotel. It's more sort of 6-star than a 5-star. But I think a lot of the international hoteliers would come in with a purely management contract play. We've seen the likes of Residor that have tried to dribble and drabble in terms of providing part equity or mezzanine funding, which has been extremely helpful for the local developers and local promoters. And then you do have one or two South African hotel companies that have got a balance sheet and are either sort of providing long-term lease or coming in and investing themselves into equity.
Right, I think there was something.
For official capital, we target the middle class, professionals. Those are the class we want to house across the whole of East Africa. We're not targeting the low income or the upper market. We basically target the middle class because we think that's where the great demand is. Second is that we are open to partnership with the international investors. I've got quite a number of them right now in the commercial buildings we have put up. So we are quite open to investors. We are quite growing. The portfolio is quite growing, and we are quite open to anybody who is interested to partner with us.
All right. Thank you very much. I think a big round of applause to the two gentlemen. Thank you very much. Moving swiftly on, still speaking about financing real estate. Super Sengupta, I think you're here. I see you there. I think yours is by yourself. Luckily enough, I won't get to throw nasty things at you. I get to throw nasty things at you guys. Please come on. Fine. You guys take over. Take my stage.
Good afternoon. Good afternoon. This is always a difficult time just before lunch, but I'll try and give you some inputs. Just to introduce myself, I am Supriyo Sengupta. I am head of marketing and product development at I&M Bank. To start off with a little introduction on the bank to put my presentation on perspective. I&M Bank is a mid-tier commercial bank. It's a regional bank, and we are headquartered here in Kenya with 24 branches, and we have a presence in Mauritius, where we have about 15 branches. We have a presence in Tanzania, where we have 5 branches, and in Rwanda, where we have another 15 branches. So we are a regional commercial bank. We are also, within our portfolio, quite a major financier of real estate developments in this part of the world. So that's the perspective from which I'm talking to you today. With me, I would like to introduce my colleagues. This is Srinivasan. He is the head of commercial banking. And that's Vinnie Hunja. She is a senior manager corporate banking. And between them, they handle the entire real estate lending portfolio of the bank. So as I talk during my presentation, if you have any questions, feel free to ask and interrupt. And I have the experts with me also who will be able to respond to some of them. Okay. Right. I'll begin with giving a little data on real estate financing. And this is Kenya-specific data. How active are banks in real estate financing in Kenya? As you can see, in terms of volume, this is 2009 to 2012. The volume of lending to this sector has steadily grown. Now, during the various presentations and inputs that you get today, a lot of risks are being discussed, political risks and exchange rate risks and all kinds of risks of investing in this part of Africa. But this is the bottom line. The lending of commercial banks has steadily been going up. It proves the resilience of the local real estate financing market. And this data also includes not just developing project, financing of development project, but also home mortgages. Yeah. So as you can see, it steadily goes up. This is a slide on data on what percentage of the lending of commercial banks goes towards real estate financing. And you will see that it's actually been going up from about 12% in 2009 to almost 16% in 2011. For I&M Bank, which is, as I mentioned, quite a major financier of real estate in this market, our figure is close to almost 25%, which is quite significant. And real estate represents the third largest sectoral lending for I&M Bank after trading and manufacturing. Yeah. So this is a serious business for banks here. And the message which I want to give you on behalf of banks is when you are investing in real estate projects, at least from the regional banking sector, for good projects, you will not have a problem in financing. We are based here, we believe in this region, and we put our money where our belief is. Yeah. Right. Now I'll go in. The rest of my presentation is on the science of real estate financing as we practice it here in the region. This part of it, for some of you many of you I'm sure who've been in serious project financing with banks, might be a little elementary, but just feel free to ask questions around it because we can go into a lot more details, but I've just left it to the basic guidelines. Real estate financing is, in banking parlance, is quite a simple financing to understand. And I'm talking about project financing now. You start with the land, you start developing it, and by this time you've probably tied up your financing. You come to the shell part of it, and by this time you're probably started selling quite aggressively. And this is your finished project. So it's quite end to end, it's quite simple to understand, analyze, but there are lots of pitfalls and things can and do go wrong all the time. Right. So what is unique about financing construction projects? As I mentioned, it's quite simple. It's the asset, it's very specific, the asset. There is a project and you are looking at it, analyzing it and financing it. It's limited life because typically within 1 or 2 years, depending on the size of the project, you've got in and got out. It's the timelines are quite specific. As I showed you, there are 4 stages of that project, and it's fairly easy to analyze each of those phases in terms of timelines. Single purpose, build a project, get out. It's independent in terms of the fact that each, in most cases, the developer has formed a separate special purpose vehicle or company, and they are executing the project and getting out of it. And there's negative to positive fund flow structure. Again, obviously, it begins with investing in the project and ends with selling it with positive cash flows or renting it out if that's what you're doing, getting out. Right. What are the uncertainties of project financing in this part of the world? The sale price or the rental price and the input costs, the timeliness of the project, and obviously having an impact on the interest rates of the borrowing. Sale and rental price, this part of the world can be quite speculative. We've fortunately, in the last few years, we've seen them just going up. It's difficult to predict it. And the input costs can be volatile. A lot of the components which go into the real estate are imported, for instance, in this part of the world, and you're open to exchange rate fluctuations on those input costs as well. The interest rates on borrowing have fluctuated quite a lot. We saw in year before last, there was a huge increase in interest rates, which really was a big challenge to developers who had borrowed for financing. Some of you would have faced it. So there is an element of speculation and there's an element of domino effect, which are the risks for project financing here. How does a bank look at a project when it is brought to us by a developer? Basically two things, the technical feasibility and the financial feasibility. There's many times that when a project is brought to us, weaknesses in either the technical feasibility or the financial feasibility is very apparent when you just look at it. But it's many a times we've seen that developers actually, even when they're looking at a project, sometimes miss out the very obvious in these things. Technical feasibility in terms of how good is the location, how good is the design, the equipment, know-how, resources, etc. Developers do put a lot of emphasis on this because that's how good is the project. And the financial feasibility, sometimes there are very obvious weaknesses we see. The solvency, the profitability, the liquidity, and the cash flow. Right, if you have the correct financing structure, obviously the project goes smooth to completion, facility repayment, everybody is happy. Structuring of your financing. How much financing do you want? Who will finance it? And when do you want that financing? These are the basic three things, criteria for a good financial plan for a project. How much? Project costs, there's a land cost, there's a construction cost, there are professional costs, architects, lawyers, etc. And there's a financing cost. The financing cost depends a lot on the other three, obviously, right? Now, who will finance these? Basically, there are three sources. The developer, from the banking side, he or she is the borrower who's developing. The bank, which is the debt financing. And the buyers of your project, of your property. Sale proceeds, basically. For rentals, of course, the last component is not there because you expect to pay back from the rentals. Now, this is typically an example of a model of how financing is structured. You have the land cost of 50 million, you have the construction cost of 100 million. These are just example figures. The professional costs, which are 15 million, and the financing cost, estimated to be 15 million, 180 million project. Now, there are numerous combinations and permutations as to how this financing can be done. For instance, very often we find somebody's come to us saying that we already have the land. And it might be that, for somebody my father had bought it in 1972 and it's available, or I've already bought the land some time back. So this land cost component immediately can be zero. But how do you finance this? There's the borrower, there's the bank, the developer, the bank, and the buyer, as I said. This is an example of how it could be. So, for instance, the land cost most of the time is typically paid by the developer completely. And the construction cost is where the bank comes in, where they have the biggest component of the financing. And the ultimate sellers, ultimate buyers, the buyer, as they start buying, that component comes into the construction cost as well. Professional costs, largely by the borrower and the buyer. The bank doesn't get into financing the professional cost. And finally, the financing cost, obviously, the bank is not footing that, they're earning that. So this is an example of a structure of financing. And when you are planning a development project, it's very, very important that this is properly planned and discussed with the bank. Because this structure can make or break the project in terms of profitability. And then, of course, the cash flow. When do you borrow how much from whom? Yeah, in terms of time. So typically, to begin with, it's always preferable that the developer's contribution comes in first. Because two things. One is it helps reduce your financing costs, because obviously you borrow for a lesser period if you're borrowing from the bank later on. And secondly, the component of the cost goes down because you also have started selling some properties, so some of the units, say for instance, so your financing component goes down. So this is an example of how it could move. For rental, for properties which you're building for rental, the buyer component is nil. So it's just the developer and the bank financing. Right, this is a bit of detail, but I'll just briefly mention, when you come to the bank, what are the typical terms? The fund is done on a reimbursement basis directly to the contractors who are doing it. We like to look at stage-wise contracts and reports, progress reports, etc. on the development. The loan amount, the repayment period, and the grace or moratorium are three very key components which we discuss and agree with you. And then the stage-wise contribution, which I mentioned before, of the source of funds. How much will the borrower first put in? How much will the bank put in at what stage, etc. The treatment of the sale receipts, this can sometimes be a big risk element, because sometimes we see that some developers tend to channel out the sale proceeds maybe to other projects or something else. This is a key risk component for the bank, and we try to control that. So all the project flows should be applied solely to the project on hand, and no diversion or changes. Finally, the signals of something going wrong, so interest not being serviced, the expected volume of sales is not coming in, and the expected equity is not being put into the project. We have examples of a developer who's made a plan of a project based on something like 60 or 70% of the project financing coming out of pre-sales. Now, those are very risky propositions. They look attractive when you put it in a financing plan, but extremely risky, but it happens here. Security and documentation, you need to put a legal charge over the land, obviously. The debenture on the project inflows and revenues of that company. And finally, the other agreements that you have. Okay, cost of raising bank debt. There are your upfront costs. the legal fees that you pay, the valuation reports that you need to do. These are things which you approach the bank, these are extra costs. And the commitment fee that you pay. Typically, when you come to the bank, there are two components that we charge, the interest rate and the commitment fees that we charge for the entire amount that we've sanctioned. There are monthly interest costs, and there are closure costs at the end when you take the, remove the pledge, etc., in terms of legal fees. Right. How do you minimize the risks? You have fixed price turnkey contracts with reputed contractors, very obvious. Qualified, established, proven professional team. We sometimes see that developers try to go in and cut those costs by trying to develop it themselves when they don't have, say, project contract experience, and sometimes that can be a big risk factor. Realistic, comprehensive and accurate planning based on thorough technical and financial feasibility, which is what I was talking about. Cash flow tie-ups throughout the project life, very important. And finally, adequate insurance and timing with political and economic environmental factors. That was a quick snapshot of what banks look at. Any questions?
Hi there, Phil Bartram from IPD. I noticed that you don't have the viability of the project anywhere in your numbers in terms of returns back to the investors. Obviously, you've got your financing costs, but you don't look at the viability of the project in terms of returns. Does that play a part in your decision making at all?
Okay, maybe Vinny, you could answer.
That will fall under the financial feasibility. Not only does it include cash flow planning, but also the IRR, your rate of returns and all that. So it is part of the financial feasibility that you will do.
Okay, then that was a leading question. Here comes the real one. What would be a viable IRR in this market?
Do you mean for the bank or for the developer? Maybe you can answer that question better. But really, when we look at the financial projections and the cash flow projections from the banker's side, the picture becomes almost immediately clear that it's how good or how viable it is, and maybe Vinny will agree with me. It's really easy to see whether the projections are realistic or not, etc. So IRR, I don't know from the developer
It's
side.
very hard to judge because you have a variety of projects. You have 8 units being developed on a half acre. You have 150 units being developed for the low-income market. You have a mall in a proven area. You have a mall in a new area. It's very hard to compare what is a standard rate of return. That we have no demand. The return must be this much for us to finance. The project will need to prove its own viability based on the expectations of the investors and how the feasibility looks like. But it's very hard to compare and come up with one figure or a benchmark and say, unless it's giving us this, it's not going to be considered. No. Very, very, very wide range of returns between different projects. Very wide.
Yeah, I think just to help you and to answer that question, I think most developers, if you don't get an IRR of 25%, you really should look at something else to invest in.
There's your answer.
I'm Caroline Kariuki from the Mortgage Company. One of the biggest challenges in the Kenyan market in particular is the high cost of funding and also the rigidity of financiers in terms of accommodating developers who may not have all the equity. Do you have suggestions in terms of equity players or other financing structures that could work for such projects?
I think I'll ask Srini to answer that question. He handles a lot of our banks' smaller project financing. So typically the challenge which you said is faced by a lot of customers who he handles.
I think promoters' equity is a very basic thing before you take up any project. Either you should have it or you should tie it up with some other equity provider as long as the partnership works well. without basic promoter's equity, considering the kind of debt financing costs these days, the project viability itself becomes very difficult to handle. I think equity is a very critical element. Either you should have it, or probably there are quite a lot of private equity companies coming in the market who are willing to look at various projects of different sizes. Probably you should talk to them for that.
You see, it's very common to face a situation where a client comes in and says that I have this piece of land, okay, however he or she acquired it, and that's all I'm going to invest in this project. You guys finance it and I'll sell it. Okay, and it becomes extremely difficult to do that, particularly because that person who's come with a piece of land, in many cases, has absolutely no experience in developing a project. So, and it's very common in this market to have that kind of customers coming in and asking for financing.
Yeah, but one way, if you have a low on liquidity, then you want to come in with confirmed sales or booked retail space. If you tie up that way, like the table that we presented, if you have it tied up, then those gaps are covered. So one way of covering a low liquidity is to tie up pre-sales. That means you have to sell before you come to the bank and show, I have so much and I have so much in sales. Then you get your convinced.
I'm Farhana Hassanali from Hasconsult. I have a question related to the other side of financing, which is, I appreciate that development financing is a big component of the industry, but the take-up in the industry is very much related to availability of mortgage financing for the end user. There have been a lot of challenges in terms of affordability and the accessibility to mortgages. My particular question is related to mortgage take-up that's related to people who are entrepreneurs, perhaps not in formal employment. Is there any changes in the banking industry that will soon hopefully cater for that kind of market? Because it's a big market, and if developers have access to financing for projects, I believe they need to sell to a ready market.
So your question is on financing of entrepreneurs who
want to take up mortgages.
Okay, all right. Srini,
We are already providing mortgages to entrepreneurs and self-employed businessmen. It all depends on how good the business is, how the cash flows are. We don't insist on only formal employment for mortgages. We take up financing for entrepreneurs, new entrepreneurs, or who have been in business for a few years and the cash flows are stable. There is no problem on that.
I think we'll just take 2 more questions. Gentleman here.
Thank you. My name is Nirish Shah, Chigwell Holdings Limited. Last year we had this situation where suddenly the interest rates shot up. I mean, shot up by almost as good as 25-30%, up to 24%. Now, a lot of investors or developers would have factored in that if I'm going to pay interest at 15%, we can afford it. So how do you help hedge clients during that brief period when there is I mean, everybody knows these interest rates at 24-25% cannot survive for long.
Yes, in fact, I also mentioned that in my presentation. That is one of the major risks in this market, the interest rate volatility. We had interesting situations when that happened. For instance, suddenly a lot of developers wanted to borrow in dollars, foreign currency, okay, purely because the interest rates were much lower. And then we started seeing a situation where even rentals have started in dollars. Now that obviously is not very sustainable in a shilling kind of an economy. Because yes, you will agree to dollars because of pressures, but ultimately at the end of the day, the cash flows are in shillings. So that situation arose where demand for foreign currency financing happened. For banks, for regional banks, the ability to cater to that kind of foreign currency lending demand in view of high interest rates in the local market is a bit restricted, but to a certain extent it is there because we get support from DFIDs and external financial bodies who lend to us for that kind of lending, but it's restricted. Other than that, it was, I know that both of them face a lot of challenges from customers who faced this issue, and really there was very little solutions to that because, we had faced situations of 25% and even higher than that of interest rates. Okay, right, thank you.
All right, thank you. Actually, I have a question. You spoke about when you finally sell the property, do not use that. So I cannot develop and buy a Range Rover without paying you first.
You cannot develop, sorry?
And buy a Range Rover without paying you first.
It depends on your priorities, really.
Anyway, that's a nice way of finishing that. I think they deserve a warm round of applause, speaking of to finance this and just that getting into the granular details of exactly what it means from a cycle perspective. That's it for the morning session. It's exactly 1 o'clock, finished right on the dot. It's 12:59. We shall resume at exactly 2 o'clock. We've been pretty good with keeping time thus far. Nothing too much in terms of announcements. The only announcement I must make is that the lunch location is get out of the room. It's on the left. Right, Mohammed? Yeah. Right on the left. Just get there. Lunch will be ready. Do what you need to do, but please ensure that you're back in the room at 2 o'clock. Back in the room and seated. Because sometimes you come back in the room and we still take a bit of time to settle down. So that will be that. Coming to the afternoon sessions, a lot of interesting stuff coming up, including what's happening with retail, a bit of government stuff. And let me make the announcement now, but I'll make it later as well, which is with regard to dinner. There will be cocktails and dinner. I assume that is the case. It is exactly 6 minutes past 2, so we're still within our margin of error time-wise, which is a very good thing. It's very impressive. You should give yourselves a hand. Clap for yourselves. You're on track. Now, I'm taking 3 very big risks here. Risk number 1 is the fact that this is an after-lunch session, which means that everyone will fall asleep. And if you do, I promise you, I will throw something. Risk number 2 and 3 are related to the fact that I've taken off my jacket, which means 1, you see my big stomach, 2nd, you see my worn-out belts. Have fun with them. So those are my 3 risks for this afternoon, but I think we can deal with all of them. I want to invite a very, very interesting group of people to the reason why these guys are in the afternoon session. Gents, if you can please come up. As soon as they're seated, I'll introduce them, but if you're Kenyan or if actually you're East African, lots of the people who are here don't need any introduction to you. And if you're someone who likes eating a lot, one of the other people doesn't need an introduction at all. But let's just do it anyway in case you have no idea who they are. We have Jonathan, who's the only person here wearing a suit for you. Still sticking to looking good, making the rest of us look bad, but it's okay. Jonathan, welcome to the CEO of Rob Property Group here in Kenya. The next gentleman is one who I will not introduce in any form of detail whatsoever. All I'm going to say is that the next gentleman is named TRM. And if you're Kenyan, you know exactly who TRM is. If you're not, Thiagarajan Ramamurthy helped to run the biggest supermarket chain in the region and one of the biggest in Africa. Started as a small mattress shop in a little town called Nakuru. So it was called Nakuru Mattresses. They decided it's too long a mouthful and they decided to name it Nakumatt, which is the biggest supermarket chain that we know of. All right. We also have Louis Fenter. Like I said, if you love food, then you don't need to be introducing him at all. Although I wonder how come he's not as big as the rest of us are, but there you go. Trying to put up as many food outlets as he possibly can to a very hungry continent. The last person, again, if you're from this part of the world, needs no introduction, but I'll still dare attempt to do it anyway because he started in television before me, so I used to look up to him. Now he sells me clothes. Gentleman known as Mashiri Wahome from Deacons, which runs some of the high-end clothing outlets in the country and I think spreading out into the region as well. And so probably beginning with you, Moshe, just an overview, and we had in the morning about how East Africa is growing, what the picture is from an economic point of view. But everyone points to the growing middle class in the region who are obviously your prime and target markets. Is that myth or is it reality?
And why did you start with me? That's why I sat at this end of the chain. You should start with Jonathan.
You used to know it's a myth.
It's not a myth. And it's directly driven with the socioeconomic factors and indicators that are visible to all of us. The whole question of GDP growth. Yes, Africa has a very lopsided income distribution chart, which is the opportunity for us as business people, that lopsided income distribution is going to continue to form into a bell curve so that you have more people within the middle class. And so if countries are registering in this region 5 to 6, 7, Rwanda 9, maybe in Mozambique and Angola registering 10% GDP growth rates, that's creating the middle class. And that's one side of the statistics in terms of economic empowerment. The second part of economic empowerment is obviously as you go through the whole chart of wants and needs, one starts to desire a lifestyle. And because of the age of the internet and the marketing material that we're consuming on our phones, etc., every human being wants to live a better life. That's what life is about. And so people are aspiring to consume, live better lives.
There's something that disturbs me about the middle class definition, though, because when it was done last year, everyone said that Africa middle class is 300 million odd people. The definition that was used, and I think it was by the AFDB, the African Development Bank, was people who have spending power from $2 a day until I think it was 200 or something thereabouts, which is a ridiculous amount. $2 a day means 2 or 3 Coca-Colas and you're done. When you define middle class in that form, you can very easily say yes or no.